Bismillahirrahmanirrahim. Welcome back once again. Students, a soft message for you people. You must have to motivate yourself that whatever the qualitative advices and inputs you are gaining from these videos, you have to apply with all SBR practice questions as much as possible. This is called quality practice. Don't focus on quantity, quality practice. Practice the exam question according to the examiner expectation and exam conditions. That means with time management. Motivation, self-confidence, your courage definitely creates a positive result. And avoid all negativity. Be positive. Let's start. Step number 6, part C2, 6 marks. Focus exhibit 3. Number 1, requirement. Explain how fair value of non-current and current asset of GRIN at 1st April X6, including any deferred tax adjustment, should be calculated. First of all, plan. A great plan must have to develop. Rule number 1, 20/80. For 6 marks, you have 11 minutes. 20 minutes, 20%, that's 3 minutes. You need to invest for that completely understand, read, and compose your mind. 80% time, that 8 minutes must be committed that I have to complete this part of the question within 8 minutes. Now, very important, ask yourself, have you read and understand the requirement that's according to examiner expectation? You must be very careful about this. Requirement is explain, not to show any calculation. Explain how fair value non-current current asset of subsidy GRIN at 1st April X6, including deferred tax adjustment. Means here, don't forget, your working also includes, your working should also mention the deferred tax adjustment should be calculated. Number 1, for acquisition accounting, that means the first calculation is goodwill. For goodwill, the cost of investment, that's called consideration, that's parent to subsidy, whatever the consideration parent to subsidy, that should be at fair value at the date of acquisition. That we have already done with the previous video. Further, the net asset, whatever the net asset of the subsidy at the date of acquisition, that also must be at fair value. If the subsidy's net asset with the individual books not at fair value, then we required to make adjustment of fair value. And it's very common. You have been studying this concept since F3, F7. But the important point for SBR exam, here examiner expecting to explain your fair value adjustments of non-current, current, including deferred tax. So your working must have a demonstration of explanation here. So this is the important point. Before mind mapping, must have to refer the exhibit 3 first. The exhibit 3 here mentioned that with the GRIN company, the carrying amount of the net asset of GRIN company 1st April X6, it's 1st April 6, it's actually the acquisition accounting date where we will calculate the goodwill. This is the carrying amount of net assets, and it's a carrying amount of net assets. And further, next paragraphs about fair value adjustment. So that means this net asset of 348, net asset of subsidiary at 1st April XX 348, it's at book value. 348 is a book value. Now fair value adjustment. Included within the non-current asset is some land. Okay. The carrying amount of this land 1st April 2006, $50 million. So the carrying amount of non-current assets includes 50 million land. But fair values assessed to be $60 million at this date. Okay, so there's a fair value adjustment of 10 million. The current asset include finished goods with a cost of 84 million. Fair value of these goods 131 million. So two fair value adjustment required here. Land and number 2 inventory. Both fair value adjustment is about upward trend, increasing trend. Land 50 to 60, inventory 84 to 131. And don't forget, here examiner particularly mentioned also incorporate deferred tax adjustment. If examiner not mention deferred tax adjustment, ignore deferred tax. Okay, furthermore, 1st April XX, directors of Chuckle company also identified that Green company had internally generated database of customers who were likely to be interested in purchasing their products. Database of customers, intellectual property. Although there were no contractual or legal rights associated with the database, a professional expert has estimated that competitor of Green company would be prepared $5 billion for this database. That means the fair value of this intellectual property at acquisition date has identified 5 million. Green company has not recognized the database as an asset within the individual financial statement. And this is absolutely correct with respect to individual financial statement. But for consolidation, this intellectual property need to recognize, and as well as impact of this intellectual property need to recognize as fair value adjustment, and also incorporates deferred tax liability adjustment. The tax rate, the current tax rate 20%. This rate should be applied to any fair value adjustment deemed necessary. Further, this is about the non-controlling interest. Here, non-controlling interest will be calculated as a proportionate share. So this is the point. The relevant context we have read it, or in fact, if this is the second time reading with respect to student, no worry about that. It's a part of the planning. Now the second phase of planning. Apply rule number 2, mind mapping. This part of the question, it's simple with respect to mind mapping, because in this question the requirement is very straightforward. Fair value adjustment including deferred tax and required explanation. Here I suggest that you have to start your drafting by reference of fair value measurement. That's IFRS 13, 1 mark. It's not only my recommendation, but examiner also expecting this. Number two, land and deferred and the consequence deferred tax liability 2 marks, inventory and deferred tax liability 2 marks, intellectual property, that's customer list and deferred tax 2 marks. What I personally think, this part of question is a good example about drafting technique 2. Drafting technique 2 means where examiner expecting that student demonstrate ability to explain their workings. So this is a very good example. Now it's time to refer the suggested solution, but before that, I think that you people have to recall that's how the fair value adjustment and deferred tax liability works with accounting. Number one, here the case, land revalue from 650 to 60. So that means at the date of acquisition, the subsidy land upward by 10. So this is actually the adjustment at the date of acquisition. So what's the impact of credit? Impact on credit will be goodwill with the parent sharing, and the parent sharing is 48%. And remaining part related to NCI. Because this land belongs to subsidy. So our portion means Chuckle portion, parent's portion at the date of acquisition adjust with goodwill, that's 4.8, and the rest of the part related to NCI, that is 52%. This is the first fair value adjustment. If land value increase by 10, so this will consider as temporary difference and resulting a deferred tax liability. Credit deferred tax liability and the liability amount 10 into 20%. 20%. Rate of tax is 20%. 20%. If liability increases, the impact on debited with the same structure, goodwill, $0.48 and debit NCI. So actually this will be the adjustment reflect on the consolidated balance sheet. On the other hand, inventory. Examiner here not expecting to develop any logic. By the way, you must have to aware about the logic. Why this is a temporary difference? Because we revalued the land according to IFRS 3. But tax authority not considered this revaluation, and this revaluation actually considerable when the asset become disposed. So even though management has no intention to sell the asset in near future, but this difference will reverse at some time when asset become realized. At some time standard says that consider that it's temporary difference. So it's not a part of the lecture that why we are creating the deferred tax liability. How creating the deferred tax liability, that is the point. And even this double entry is not the requirement of the question. It's just about to recall. Same for the inventory. For inventory, debit, that is the difference between 84 and 131, is equal to 131 minus 84, 47. And the impact on goodwill and NCI, 47 into 48%. Don't confuse, sir. Parent sharing 48%, NCI 52%. Don't worry, don't worry. That's a point of inventory. Same impacts. If inventory value upward, it's a temporary difference with respect to the deferred tax. Once again, at the time of acquisition, deferred tax liability 47 into 20%, 9.4 multiplied by 48%. 9.4 multiplied by 58%. That's inventory. And same case with respect to database. So these things you must have to bear in your mind. You have to explain this. Intangible asset, that's 5 million. .48, 0.52. And same impact on the deferred tax is equal to 5 into 0.2, that is equal to 0.48, 0.5. And that's it. That is what the working about, but examiner not expect to make a double entry of working rather than explanation of this working. And believe me, it's not very much difficult. It's just about the practice. Now, it's a suggested answer. It is necessary, suggested answer here. It is necessary for the calculation of goodwill that Chuckle measures the identifiable asset acquired and the liabilities assumed at their acquisition date fair values. So it's a very basic reference with the connection of the case. Very simple language. The calculation of goodwill, that the parent should measure the identifiable assets of the subsidiary at fair value. Assets and liabilities at fair value. Or you can use the word identifiable net assets directly, not specifically mention asset and liabilities. Number one, refer to IFRS 13. Fair value should be representative of the amount which market participant willing to sell asset or transfer liability in an orderly transaction under market conditions. That's the point. Market conditions. That's the point. So this is what about the startup with the reference IFRS 13, and you will be able to gain 1 mark. Then land and deferred tax. It has been identified that fair value of land 10 million above the carrying amount, and this increased 10 million create additional taxable temporary difference. And the carrying amount of land increased by 10 million, but tax will not consider. No alteration with the tax base. So the deferred tax liability arise at acquisition date 2 million. 2 million deferred tax liability. Since deferred tax is identifiable liability at acquisition, should be recognized on acquisition with the corresponding increase in net assets. That's 8 million. That means asset of land increased by 10, liability increased by 2, net increases by 8 million. Net asset increased by 8 million. Number 2, inventory and deferred tax. This red highlighted point is just for your information. It's just for your information. Number 1, one thing that is fair value, one concept that is fair value, and another concept is NRV. NRV term used for inventory, but fair value and NRV both are not same. Fair value reflect only the fair price that's which an orderly transaction sell inventory in the principal and most advantageous market for that inventory would take place between market participant at major date. So-called the price at the price based on exit price, that is market based. This is fair value. But NRV reflect some net amount that an entity expect to realize from sale of inventory in ordinary course of business. Do remember, fair value is something based on market based, but NRV is something based on entity specific. If entity will sell the inventory with what value after adjusting cost of disposal and any selling effort that need to be considered. Here I have mentioned that NRV of inventories may not equal fair value less cost to sell, because very apparently the difference between fair value and NRV is a cost to sell. But what the condition for consolidation? What accounting standard says? What accounting standard says about inventory at acquisition date of subsidiary? Should it be at fair value or something about NRV? So this is what the concept I've mentioned. Inventory should be valued for consolidation at estimated sales price. Sales price means entity specific price. Means what's the entity ability to sell the asset rather than what is the value in the market. So estimated sale price which an entity would be able to sell it, less cost of disposal, the sum of cost of disposal and reasonable profit allowance for selling effort of acquiring entity. That is the point for consolidation purpose. So here there is no complication. Simple, the data available, fair value. Whatever I have discussed with you, that's for the knowledge. But examiner expect that you have to mention as a knowledge here. Finished goods should be valued for consolidation, estimated sales price and less cost of disposal. But here the only one thing given, the fair value of finished goods. So we will assume that this fair value actually the estimated sale price less all the cost. So fair value finished goods 131 million and the fair value adjustment 47 million. Because 131 minus 84, that is 47 million. That's same we have done, 47. Fair value adjustment. This creates further taxable debt difference in consolidation financial statement of Chuckle with corresponding deferred tax liability 20%, 9.4. Same, we have done this. So that is what you need to explain. Simple. No need to explain the impact on goodwill or NCI. It's just for your information, for your knowledge. Here, examiner only expect the fair value adjustment and consequently deferred tax liability. That's all. About customer list, come on. It is correct that database as an internally generated intangible asset not recognized in individual financial statement of Green Company. It's not recognized in the individual financial statement of Green Company. Absolutely right. But on acquisition, Chuckle should recognize database as separate asset from goodwill in consolidation, providing database satisfy the criteria of recognition. And it's the criteria already meets here. Already have met here. Criteria for recognition as an intangible and their reliable estimate of fair value can be determined. Although there is no contractual legal rights associated with the database still appear identifiable because the value is determinable, because it could be sold separately to the competitors. The professional expert valuation means a reliable measurement. 5 million would appear to provide reliable estimate of fair value. So the database should therefore be recognized in the consolidated financial statement of 5 million, and implication of deferred tax liability also arises equal to $1 million. So that is the point about the customer list. That's all about the question, but very important point. The examiner report inside about this question. Very important. This requirement carries 6 marks. Therefore, a substantial answer was expected from a candidate. That's number one, the examiner expectation. As soon as fair value is mentioned in a requirement, examiner saying the principles of IFRS 13 should be used, not the detailed discussion. About IFRS 13, this does not mean that definition of level 1, 2, 3 are required every time, but it does mean that relevant section of IFRS standard should be quoted in the answer. Significant number of candidates did not consider the deferred tax implications, despite being specifically asked to, and as result could not gain full marks for the question. That is what, with this series of session, at least 10 to 12 times, I strongly suggest to you, with every part of this video session, read the requirement carefully. That's a complaint of the examiner. Student ignore deferred tax because when reading the question, they are not considering everything. That's carelessness, nothing else. So read the requirement very carefully and start practicing this action from now, from day one. So that is all about this part of the session. And after that, the last part with the pre-populated spreadsheet function. Wait for my next video. Thank you very much. I hope that you people have got very valuable insight. If you have any question, you can ask me. But believe me, this is what a quality practice material for you. Focus on quality, not the quantity. Thank you very much. Assalamu alaikum.